Welcome back to Click Capital, everybody. My name's Jared and I'm your host today. And if you're new to this channel, hit the subscribe button and I'll keep you updated every day with all the most important news, data and charts from the markets. And today was green across the board with the market going back to the growth trade. We can see that with the utilities, consumer defensive and healthcare came off a bit. And all the growth cyclical stuff had a good day. Even finance and energy showed up as well. NVDA had a little bit of a bounce back today, up a bit over 5% on an inside day pattern. And the media is still talking up the stock. We've got headlines like NVIDIA, Microsoft and other tech stocks could tumble, but don't sweat it. Tech stocks have had a spectacular run and you might be tempted to sell them to avoid the inevitable dip. But if you're a long-term equity investor, hang on to them. Some of the biggest names out there from Microsoft to NVIDIA are still reasonably valued once you factor in how quickly they're growing earnings. Here's another one. How high can NVIDIA stock go? And we continue to see more like it. Like here, NVIDIA stock might still be the best way to play AI. And we've just seen a lot of media and journalists and Wall Street just justifying the big move up in the stock. However, if you're watching my videos last week, you know I predicted that the insiders were going to start selling into this. And that's exactly what we've been seeing the last couple of days. So we had earnings come out on the 25th of May. Then the next day we got a huge sale from someone on the board, almost $38 million. Another director on the same day sold $3 million worth of stock. And then we've just had the CFO actually sell $2.5 million as well a couple of days ago. And I wouldn't be surprised to see Jensen Huang, the CEO, offload a large chunk in the coming days or weeks as well. Dark pool buyers have their largest ever net short position in the stock as well, to the tune of almost $19 billion, and that's grown over the last couple of days. So while we see the stock rip up and lots of people buying call options in it, the media and Wall Street upgrading their targets, saying it's just getting started, it's not too late to get in, the $1 trillion valuation's justified, etc., etc. Just remember, if you're buying up here, you're buying off insiders and dark pool sellers. And me personally, I'd rather be on their side than on the side of the media and what Wall Street analysts are telling me to do. So I'll continue to remain short the stock. My last ad was at 414. We could still go higher, up until the mid-high 400. Who knows when exactly it's going to top out. But just looking at the weekly chart, it's significantly overbought and it can't keep going on forever. On to other news today. Looks like the debt ceiling passed through the House. Now it's just got to go through the Senate. So that's moving along as expected. And you got to laugh at the name politicians give to these programs. It's like they just think up what is the opposite name to what we're actually doing. And this one's a doozy. Look at this, the Fiscal Responsibility Act. I mean, is this a parody? Or are we really living in a simulation? So let's look at what they call their fiscal responsibility. So basically the debt deal is going to largely suspend all non-defense spending and maybe cut about $100 billion worth of spending and just kick the can down the road until after the next presidential election, conveniently by a few months. However, the US government still takes in way less revenue than what it spends that it's suspending. So the deficit's around $2.5 trillion to maybe up to closer to $3 trillion over the next year or two. Who knows, if we get a recession, then the government's going to take in less tax, that's for sure. So you're $31.5 trillion in public debt as it currently stands. And the Treasury's pretty much got a blank check to keep increasing that until early 2025 after the election. Some projections is that's going to blow out to at least 34, maybe 35 trillion by the time we get there, up about here. Now, I don't know about you, but this chart to me and where it's projected to go doesn't look like fiscal responsibility. It looks like them selling out the millennials and future generations by saddling them with a lot of debt they're going to have to pay back. However, that's a story for another day. What we're focused on the channel here is how does all that affect us as traders and investors? And basically it just keeps the party going. So the market likes that because the government's going to keep spending. Because if the government really pulls back their spending, then that's going to affect the economy, business, and the markets as well. So it just kicks the can down the road and keeps the party going in the markets. And that's what we saw here today with SP 500 just slightly finding new highs for the year. The NASDAQ didn't quite find new highs for the year though. However, we just close a little bit higher tomorrow on the NASDAQ, the week at 352.70 on the Qs. If we close higher than that tomorrow, that'll be the 6th week in a row the NASDAQ has closed higher than when it opened. And that's coming into this really overbought level here in this resistance zone. Got a bunch of economic data out today which helped as well. Got the weekly jobless claims coming pretty much in as expected. Got the ISM manufacturing PMI came in a little softer. Crude oil stocks continue to grow and the global manufacturing PMI is still in contracting territory under 50. And the big one tomorrow is non-farm payrolls. So the unemployment rate's expected to tick up a little bit to 3.5%. So as expected, 190,000 new jobs have been added to the economy in May, and the Fed will be really looking at that data point to see what they're going to do in a couple of weeks at the next Fed meeting. And surprisingly, the Fed Fund futures market have moved down the probability to 20% that they hike. I think that's still on the back of comments yesterday that we got from the Vice Fair, who said they could probably pause in June before reassessing. However, this probability's been moving around a lot over the last couple of weeks. And I think we could still go back above 50% probability before the Fed meeting in June 14. That's because the jobs market is tight. We've still got sticky inflation. The banking crisis looks to have cooled down. And I think the Fed and Jay Powell kind of has to break the jobs market to really get inflation down to 2%. I think as long as the unemployment rate is under 4%, it's going to be hard to get inflation under the same number as well. So he's kind of already hinted it the last couple of months that the economy might lose a couple of million jobs, and that's kind of what's needed to structurally change inflation. So I still think all that gives him permission to keep hiking as long as we've got a tight jobs market and inflation is sticky above 4%. They have permission to keep hiking, and a lot of Fed presidents around the country have been saying the same thing as well. And just looking out to July, the market's still got a slightly better than 50% chance that there will be a hike by July. Still a lot of optimism about this market out there, with the fear and greed ticking up to 68, almost in the extreme greed zone. And that's largely due, once again, to a really busy options market, with an unusually heavy day today on a Thursday, with 41 million contracts changing hands and a huge 58% calls. And the mega cap tech just have super low put percentages, so still a lot of people just loading into the calls on the big guys. Dark pool buyers pulled back a little bit here today, down to 48% on the DIX. Corporate insiders still selling more than they're buying. And here's an interesting chart for you today. So in this dark blue line here, that's the combined market cap of the top 7 mega cap tech stocks: Apple, Microsoft, Alphabet, Amazon, NVDA, Meta, and Tesla. And now that combined market cap of those 7 stocks is greater than the combined market cap of the energy, materials, industrials, and financial sectors combined. So that's for the first time ever. And just once again, another illustration of how concentrated and big the top end of the market has got. You now got 7 stocks worth more than the combined market cap of 4 other major sectors. And there seems to be a lot of people that think that can go a lot higher, and we can see that in the call option activity of those 7 stocks. Just every day, super high call percentages. People betting that that's just going to keep going higher and higher and higher. However, if you look back throughout market history, you'll just see that moves like this and concentration in the indices is not sustainable. And since we're starting off the month of June, here's a look at some seasonality for you. Looking at the SP 500 back from 1950 till today, June is typically a pretty flat month. Most of the time coming in around unchanged by the end of the month, maybe slightly a little bit positive. And typically from June to September is a weak time in the stock market. There's the old saying, sell in May and go away. And typically it's mid-late October into the new year, late January, that we typically see the most bullish period for the stock market. So the main indices, SP500 and NASDAQ, have had a great start to the year as we reach the midpoint. So maybe at these overbought levels and with this bearish seasonality, over the next couple of months, we might see that big pullback and correction. Okay, back over to the charts, and the international stock indices are trying to find their footing here down in oversold levels. There's the FTSE, the DAX has done a bit better. The Nikkei is the winner out of them all, still holding up there near the highs. And the Aussie and the China having a little bit of a bounce back. Volatility absolutely dived today, especially up the front. Here's the VIX 9-day now under a 14 handle. And the main VIX itself, super low down here at 15.5. And just looking at a weekly chart, we can see that's just about as low as we've been ever since the market peaked out in late 21. And that can be a good contrarian signal. So I've just overlaid the S&P 500 on top of the VIX chart here in the orange line. And you can see the last couple of times the VIX got really low. Back here in late 21, we had the VIX come down to 17. And that was right around where the S&P 500 peaked and then fell off. Again, back here in March 22, when the VIX had come off for a month or so and got down into the 18s, we saw the S&P 500 have a bit of a swing high and fall off about 800 points there as well. Again, here in August 22, the VIX came down really low. S&P 500 peaked out, sold off. And a little bit back here in January, we had a little bit of a pullback. And here we are today with the VIX super low, and the market has had a pretty good run this last couple of months. Longer data options as well. 6 months out dived on their IV. You can see that in the VIX 6 month coming off today, down to 21, which is as low as it's been for a while. Bond market volatility had a little bit of a pullback, but still super elevated relative to equities. Another good contrarian indicator is the put-call ratio in equities. And that shows you the percentage of puts versus calls. So here at 0.78, that shows what we were looking at, the option activity, a lot more calls being purchased. And this is a bit of a messy chart, so I'll just overlay a moving average onto it. And that's a 5-bar moving average, just so we can kind of get an easier look of where the overall open interest in the option market is. So currently we've got the 5-bar moving average at 0.78. And I'll just overlay the SP500 again in the orange line here. And so the market is really great at buying a lot of puts when there's a lot of fear out there. You could kind of think of it as people waiting for their house to flood, then going out and buying flood insurance. So you can see when the market comes off, we see the put-call ratio go higher and higher. And you can see the MA just up here in the indicator screen. So the last time the market had a bit of a dip, the moving average on the put-call ratio got to 1.5. And the opposite is true as well. When we last peaked on February 2, the put-call ratio MA was at 0.75. And you can go back and see that time and time again. When the market is going up, everyone's buying calls, no one's buying insurance. The market comes down and then everyone buys puts. And we can see that again back here in March when we had that swing high. S&P 500 ripped up to 46.31 and the put-call ratio moving average is at 0.66. And as the market fell, so did the put-call ratio rose, and we're up here at 1.13, right when we're at the bottom of the dip. So that can be a bit of a contrarian signal. So with the moving average here at 0.78, that's pretty low, and the market's had a pretty good run here. So a lot of people buying calls. Typically, in the long run, they won't be right. And what's strange is with that low VIX and low put-call ratio in the open interest, we've actually got a really elevated skew at 151, and that's the price of out-of-the-money SP500 options. So the cost of tail risk insurance. So if the market does start to crash, it's already too late to be able to buy cheap out-of-the-money insurance, and this could even go a lot higher. So a lot of the market is not positioned for a big pullback here, and if we do get one, then people are going to be paying up big time for those out-of-the-money puts, which are already expensive. A little bit of a bounce back in breadth today, but still more than half of stocks underneath their 20-day, 50-day, and 200-day averages. And we've still got more stocks making new lows compared to new highs. But the strength in the top end of the market in the mega cap tech is keeping the growth spreads elevated up here. And we can see that in high beta stocks versus low volatility. And the growth versus value spread still holding up at year-to-date highs. And looking at the growth commodity copper versus the defensive commodity gold, that spread chart is still in a downtrend. And that's forecasting weaker global economic growth ahead. You can already see that showing up in the numbers as well. As the post-COVID recovery comes off a bit, along with all the government stimulus and central bank stimulus, that's all reversing course over the last couple of years. And so Fitch Ratings said trade will expand by 1.9% this year, down sharply from 2022's growth rate of 5.5%. And of course, China plays a huge role in that, and their economy is stumbling a little bit. Got international stocks trying to put in a little bounce here after being significantly sold off versus American stocks the last week or two. Got the yield curve stabilizing. And government yields continue to pull back. Got the 10-year here at 360, along with a little bit of a pullback in Fed Fund futures. And TLT almost back at its 50-bar VWAP. High yield bonds still on downtrend territory. And as I predicted yesterday, we've got a little bit of a pullback here in the dollar index. Same with Bitcoin, looks to have lost its 50. Commodities trying to hang in there and reclaim this big support zone. Gold as well, just sitting shy of 2,000 an ounce. Another big move up in uranium today on volume. And over to stock sectors, green across the board except for the defensive stuff. Utilities and staples, still trying to find a bottom down here in these oversold levels. Gold miners was the winner today, coming back on volume. Little bounce back in the semi sector. I still think this could potentially be an island reversal formation. Energy stocks looking to find support down here as we got a little bit of a bounce back in crude today. Same with defense stocks. You've been hearing me speak about the support level. And because the government's not suspending increases on defense, that looks to have supported the sector here today. BlackRock just holding on to its 50. Another good day for Tesla, close to finding new highs for the year. Apple found new highs for the year. However, looking at a weekly chart, we are a bit stretched up here. Apple stock has grown 45% since that October low. And I can see dark pools are short the stock as well. Same with Microsoft, coming up to its all-time highs, could find a bit of resistance, and since this October low, we are up 57%. And dark pools have an even bigger shorter position in that as well. Other trillion-dollar stocks, Amazon and Google holding up. And Meta continues its march, finding new highs for the year. Same with Netflix. Bit of green in the meme space today. Here's Carvana. Not giving up just yet, up 22% today. And there's C3 AI after its earnings, down 13%. A few more earnings today at the back end of this season. We had Lululemon come out and beat expectations. We're up 13% in post hours. However, the stock had already come off quite a lot in the last couple of weeks. Macy's beat as well, but the market not doing much. Same with Nordstrom beat, and the market popped it up almost 5%. Dollar General missed though and got hit hard, down 20%. Advance Auto Parts continues to slide. Target found new lows today, but looking to try and find support here. And the regional banks continue to hang in there. Okay, back to the SP500. We saw global net liquidity jump a little bit here today, but we've still got over a 400-point gap. And of course, we've still got all those other divergences in the market, with junk bonds trading weak, the overall breadth in the market trading weak. We've got the copper gold spread trading weak. The dollar has moved higher, rates have moved higher. All these things say stocks should be lower. So just following all the data in the indicators is still keeping me net short, 40% in the portfolio. And for those of you who are wondering, I'm not a perma bear. I just follow the data. It doesn't work every single time. But in the long run, you can grind out a casino-like edge with it. And up until late 2021, I was mostly net long for quite a while. But ever since we had those huge divergences in late 2021, I've been mostly net short since then. And if the data changes, if we see improved breadth and central bank liquidity coming back into the system, junk bonds ripping, if we see all those other things, then there is a potential for me to get net long again. But I think the big one is inflation. We'd really have to see inflation come down. Then the Fed could decrease rates, and then the relative valuation between stocks and bonds would improve. So I'd really have to see inflation come down and breadth in the market to improve before I change my bearish stance as it currently stands. But of course, it's always a dynamic, fluid situation. Anything can happen in the markets. And that pretty much sums it up for today. I wish you luck as we go into the last day of the week, and I'll see you again tomorrow afternoon.